Maverick traders, welcome out to your Maverick Currency midweek update for February 8th, 2023. Corey here with you. I missed being with you last week. I just look forward to these midweeks, but I was traveling with my family in Puerto Rico. We had a wonderful time, but nice to be back and nice to be back with all of you. As always, a quick reminder to make sure you follow your trading plan. And boy, do we have a lot to talk about today. So last Thursday, I think was a pretty important day. Now, those that have been with us certainly know that I have been bullish, expecting a market rally, expecting a push up above the downtrend line, all the things that we've talked about for a number of weeks. And boy, oh boy, has that outlook changed as of Thursday of last week. So we're going to spend today certainly going through a lot of charts, but let's kind of check the boxes. Stocks are in a bear market, but we've been bullish, and I've been highlighting an ABC correction. That has now fully played out in my opinion. I suspect last Thursday was the important reversal. Now this is kind of a signal of a variety of different things. I think the US dollar has bottomed. I think we move into a more bearish, choppy first, but bearish outlook big picture, and that ultimately there's going to be some wood to chop. The markets still have to deal with a Fed that has to deal with inflation, and I think we passed the sweet spot. We passed the sweet spot where inflation was really on the decline. What you're starting to see now, and what will only show up in the data later, is a change in prices, and inflation I think is going to stay sticky, not perfectly decline down to 2%. I think it's going to stay stickier in the 4% range, 5% for a little time, and then kind of gravitate a little bit lower and maybe hang out at 4 for a while. And that's twice the Fed's outlook, and they're just not going to have the capability and capacity, I don't think, to cut rates or do anything that way. So this has really played out where we passed the sweet spot, I think, for the markets and for risk taking. So in my opinion, as currency traders, we're basically headed towards risk off mode, that we are going to have some declines in stocks and some trading where a long US dollar, long Swiss franc, long Japanese yen type of outlook makes more sense. These are historically more defensive. They should act more defensive. I'd be more bearish on, the Euro's had some run in it. I think it should kind of stall out a bit. I think that Aussie and Kiwi and CAD and some of those, now maybe these correlations don't play out as aggressively as they have in the past. There is a little bit of truth to that these strong risk on, risk off, this used to be more of something that you would see play out really well, and it's been a little bit more hit or miss for the past year or so. It hasn't been as highly correlated, but just generally speaking, kind of picking your spots. Like right now, I still like a long US dollar outlook or a long Japanese yen outlook. And we'll look at some charts and kind of make sense of this, but this is a big change. I don't really make, too big of change. Like, I'm not changing my outlook every single week. Oh, this week we're aggressively bullish. Oh, next week we're aggressively bearish. You know that for the past couple of months, really since mid-December, we've been talking about a bullish risk-on environment in equities, and it just played out perfectly. So let's spend some time in charts. I want to go through a couple of different things here today. Maybe we'll start where we should start, with currency. And I'm going to pull up the US dollar index, and we look at this chart from time to time, and it's a good one. It kind of speaks to the long term, and we're still below that 104 level. 104 doesn't look that magical on this particular chart, but as you back it out quite a ways, all of a sudden 104 becomes a key zone. So 104, if we drag a line here across 104, you can see it was basically the peak in 2017. the peak in 2020. We broke through it in 2022 and made a big move to the upside. We've come back down in late 2023, broken below it, and spent some time below. The last bit, in fact, we even shorted Aussie USD. If you joined me on Monday evening for the RBA statement, we shorted Aussie USD. It was a good trade. I wouldn't call it a great trade, but it was a good trade. Certainly pips were made and such. It started off great, and it went down to our first target where we talked about taking some profit, if not all. And if you targeted the lower range, it didn't get there. So that's why I say good, not great. But anyhow, some pips should have been made, certainly. But you look at this chart, and we're underneath 104. I tend to think that we're going to be able to get through it on this longer term outlook. If we come back into the short term, it may struggle there for a period of time, perhaps. But even just to get back towards 104, like if you take a little bit of a pullback here for a day or two, you can easily push up there, I think, and be messing around with 104. And I tend to think that this bottom has kind of set here for a period of time, that we're going to establish some upside. Now, I mentioned that this was really a change for me last Thursday, so almost a week ago. And if you look at what the dollar's done so far since last Thursday, pretty good. Why was last Thursday important? Remember what we talked about. Remember the big picture, and these things all play out together. So it's no surprise that the dollar bottom really correlated with the market top. So I'm not going to rehash everything, but we've talked about this so much that basically, well, let's do it quick. Just a quick recap. 1, 2, 3, 4, 5, right? There's your Elliott waves. A, B, C, and the C here usually goes up to about where the fourth wave was, right? So you're kind of creating that. We had a downtrend line in place here that was, and I talked about this in mid-December when everybody was ready to jump off a ledge and so bearish. I said, look, I have conviction that we're going up, and not only going up, going to break above the downtrend line, et cetera, right? So bullish outlook, and it played out. This was a max pain. This was something where sentiment was so offsides. They got completely bearish at the wrong time, when ultimately you should have been buying if you were expecting and had the right outlook. That was a great buy point. Certainly not a time to be bearish in this ABC correction. And in terms of looking at this, if you think about sentiment, I'll use this as in equities, but it's kind of interesting for people. There's something called a put-call ratio. And if you look at this put-to-call ratio and you go back 20 years, what do you see? You see that something crazy happened in December. That a high reading is up here and a low reading is down here. And this is how many puts are being bought compared to how many calls are being bought. Now, if the reading is high, a lot of puts are being bought. If the reading is really low, very few puts are being bought. In other words, a lot of calls. So this is times where there's low put readings. And here's times where there's high put readings. The high ones are more instructive. This is basically people buy puts when they're very bearish, when they expect a huge downturn, because they pay off, right? Look at where the biggest readings were. At the end of March 2020, they loaded up on puts. Why? Well, it's a form of insurance. It can protect your portfolio, but basically, make a long story short, the market had cratered because of COVID. And if you were saying where was the best place to buy stocks over the past couple of years, you'd point to that exact spot. That when they were off sides and so negative, it was actually a buy signal. And sure enough, the markets rocketed higher. If you go back and look here, in 2016, the markets were off sides, way too bearish, and a good buy point. You know, here's '08 after Lehman's crash, people just crazy nervous and so on, puts exploded, a good buy point. This one exceeds all of it. What happened in December of last year was crazy, crazy bearish. People so negative on the markets. And it was a fantastic buy point. It's in the last 2 months, we've gone vertical, right? The S&P's up 10% plus over 10% or whatever from that low. So from that A, B, C, right? So that's what played out. And this was kind of a sentiment gauge that basically helped us in terms of the analysis. That again, equities were going to make this run higher and to be a little more risk on, and US dollar bearish on the US dollar. Again, these things tend to move in inverse. If you're really bullish, generally speaking, if equities are having a big run higher, the US dollar will oftentimes be having a big move lower, right? It's a currency that tends to move inverse. Also, when the US dollar is moving down, of course, gold would be going up and commodities in general would be going up, maybe even Bitcoin as a risk asset has been going up and so forth, right? Risk on versus risk off, that direction. I think there's a bit of a turning point that should start to happen here. That in essence, we should start to see the reverse of that, the inverse. Now, I don't know if it's exactly here, but look at what happened in the NASDAQ. One of the things that I said to watch for was what I call a big exclamation point at the end of this, meaning you're running higher, running higher. Watch for a big ramp and some sort of exclamation point. Like, how about you turn vertical and then you gap way up, right? This puts a punctuation mark at the end of this run. If somebody asks me, is a huge vertical bullish move bullish? Is it a bullish signal? I would say, well, it all depends, right? Context matters. If the chart looked like this and you've been going sideways, 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 and then it just starts to surge and break out, well, yeah, that's bullish and we'd expect more upside. If you've already expended a lot of energy, like that's bullish. That right there is a huge bullish candle. You're down in the dumps. That's bullish and tends to lead to more upside. Here you pulled back and you're still early in the run, and that's a big bullish candle, and that's still bullish. But I think, again, as you get more extended, think of it like I always compare it to a runner, right? You only have so much energy. You can't just, the human body cannot run unlimited amounts. You get tired, right? And so early in the race, you got a lot of energy. Late in the race, you have a bit, and you kind of, what often happens is you sprint for the finish line. You use every last ounce of energy that you have to hit that finish line. And that ultimately leads to reversal. And that's kind of what the NASDAQ did, is put that big exclamation point. So is the bullish candle here and in this big gap and so on, is it bullish? No, I would say it's bearish. Why? Because we're extended in trend and range, and we went vertical, and we had a huge gap and so on. It's the punctuation mark. It's an exhaustion versus something that's breaking out. This would look like the start of the race. This would most certainly look like the finish, the sprint for the finish, right? And that's what I think essentially happened Thursday of last week. So for me, I've been adjusting. Now, markets haven't done that much. Are they down a bit from there? Has the dollar rallied a bit from there? Yes, it's starting to play out. It should be a long ways from being done. It really should have quite a bit more to go. So again, if we kind of come back to this long-term chart, what certainly could be in play, if you think that, well, this is a huge 5-wave pattern, And now we've gone through an ABC correction, right? 1, 2, 3, 4, 5. A, B, C. What comes next? Well, a whole new 1, 2, 3, 4, 5. A whole new cycle of, in this case, if we're indeed in a bear market, there can be a lot of wood to chop. Now that you start talking about that scenario and you sound like a crazy person because, you know, markets don't tend to go down that much. But look, we went down, 27% in the S&P, 40-ish% in the Nasdaq, whatever it was from peak to trough. We could even do the math. From 405 to 255 is basically how far it went before. That's a 150-point drop from 405. It's almost 40%. Could you go another? I don't know that's going to lose another 40%. This isn't the NASDAQ that's going to lose 85% of its value, I don't think. But could we have a whole nother series that takes the market down another 20%, maybe 25% in the NASDAQ and so on? It's certainly possible. When you look at the economy, when you look at Fed policy, debt levels, all these sorts of things, we can't go back to where we were before. There's just no turning back. The Fed has been scared straight by inflation, as it should have been. And at this point, the Fed basically is locked into fighting inflation. That is their main goal, their number one objective. If it means people lose their jobs, so be it. That's their philosophy, and that's their battle that they have to fight. And by the way, they fueled a lot of these problems by making some stupid decisions. But I think in essence, we have to get used to, the economy has to get used to higher interest rates, because we're not going back to a 0% level. We're not going back to where internationally bonds traded with negative yield, which is absurd. I knew at the time that how absurd is it to give someone money. Like, imagine this. You hand someone $10,000 and then you say, you know what? I'll pay you interest for keeping my 10,000. I'm going to pay you. You take my money, and by the way, I'll also pay you for the pleasure of me giving you my money. It's the most ridiculous thing ever, but interest rates went negative, not even down to zero bound. There were negative yielding assets where people were literally locking in at negative yield. It was absurd. It was stupidity at its finest. And there were other things. But it speaks to just, they pumped so much liquidity in the system. The markets went bonkers. And now we got to deal with this. And so the Fed has to deal with inflation. The market has to learn how to get used to higher interest rates. And it's just this transition from easy monetary policy to tighter conditions. And it's like somebody that's been on drugs and now they're in rehab. And that's where the markets are at. We are getting used to a different world. We used to, the Fed used to give us our fix or whatever, and now we got to learn to live life without it. And there's going to be good days and bad days. And unfortunately, for the first little while, you have a lot more bad than good. This is really where QT began. And what has the market done since we went on this transition? This is where we went into rehab, folks, is right here. And I don't know of a better analogy. I realize I'm not making light of it. We all know people that struggle, right? And I'm certainly not making light of the situation, but that's where the markets are. It's very similar. We got to get used to this, and it's just a process. And this is what happens. This is what happens when you take away the easy monetary policy stimulus. We're off of steroids. We can't hit the ball as far, and we got to get used to and accustomed to it. So I suspect, I don't want to be crazy bearish. I don't know how much lower it's going to go, but it's probably going to be a rough couple of years, and as bullish as I was for a trade, I always mention, look, we're bullish, right? We're making this run. It should ABC correct. You stay on the gas. Well, we knew that that time would come to an end, and I think that's where we're at. So let's look at a few other things here. And by the way, you know, that's good news. That presents huge opportunities. If you're an investor of stocks, you want to buy cheaper. So, as an investor, if I'm going to be a net acquirer, unless I'm trying to sell all my stocks, if I want to be a buyer of stocks long term, then I want them lower. From a trading perspective, it presents more volatility and more opportunity and so on. So this is not bad news. This can be very positive news. As we come in and look at a few markets, let's just click around here. Maybe we'll look at crypto in general. Doing pretty darn well. Give credit where credit's due. This is a daily chart and still kind of grinding its way upward. I highlighted the reversal last week. I think that should present opportunity on the short side for the crypto markets. Again, I'm not trying to be too precise with this expectation and this outlook. Like, would it surprise me if we chopped around or even went a little higher in the very near term? No, not at all. I'm not super mega bearish like, oh, we're going to crash or something like that. It's more that I just think we've pretty much run out of gas. Now, can you surprisingly, coast in your car even after you ran out of gas for a little bit? Could there be a little bit more? Sure. I just don't think there's much in it. Should start to roll over overall. If we come over and looked at currencies, again, like we talked about, USD has already started that reversal process. I suspect, personally, I'm a buyer of dips. So I don't play breakouts. What do we always talk about? When you're trading, if you have overhead supply, then for me, I don't like chasing momentum. Like this attempted breakout above the 50, no thank you. I'm not going to buy that breakout, but I will buy the dip, right? Because as we go up, we encounter more overhead resistance and so forth. So I'm a dip buyer of USD, not chasing breakouts and such, but buying the dips. If we look at the others, Japanese yen, kind of the same. It hasn't done much for the past couple of weeks, but same outlook for me. I came in more positive on the yen for this year, and this is where it should really start to transpire. This is where things should start to break out of that range and really start to work their way higher. Swiss franc has already been in more of an uptrend, sideways recently for the past few months, and there's just no reason not to continue to be bullish. This is one where, to be frank, it's the best looking chart out of the three. I mean, it just looks like it could continue to work its way higher and have some really good price action to the upside. So those are more of the risk off currencies, the more defensive, and they're the ones that I like being bullish on for the foreseeable future. On the more negative side, I mean, something like euro, I think should continue to break down. Now, this is the opposite of what we just talked about with US dollar. This has underlying support here. So instead of trying to short on breakdowns, I'd much rather short the attempted rallies and then play it for the next drop. And then as it rallies, short that rally and play it for the next drop. I'm a seller of rallies in euro, which is the inverse of, again, I'm a buyer of dips in US dollar. It's the same concept flipped upside down. British pound, seller of rallies. Canadian dollar, this is oddly one that I'm, out of the three, I think should start to work its way higher. But again, I wouldn't buy breakouts. I'd buy dips if you wanted to play that. Australian dollar, my thought is that we should continue to work our way lower in the coming weeks and months ahead. And by the way, I mean, CAD will probably do that too. Um, Even though I think it can hold up better than Aussie and Kiwi, we're just moving into a risk-off environment. So here's the New Zealand dollar. I'd love it if this had a little bounce here prior to the breakdown, kind of an inverse cup and handle, small bounce, and then comes and starts to break down would be picture perfect. I love when you get these kind of lower highs and, call it a descending triangle or inverse cup and handle, whatever you want, looks like more of a short setup. So Kiwi, again, looking more on the bearish side. So as I rack them and stack them, it would be long US dollar and yen and Swiss franc. I mean, those are my preferred, and then everything else just more on the bearish side. I guess I kind of have personally CAD more in the middle, but I would be looking to short Kiwi and Aussie and Euro, Pound, etc. So that'd be kind of my bullish, more neutral, bearish outlook. That's how I see it going over the next couple of weeks. So, as is always the case, I mean, the market ultimately grades your work, grades your analysis. We try to paint a picture, is what I call it. I always try to paint this picture of, okay, how, and it's multi-leg, right? How is the economy going to do? And how are people positioned? And what is their sentiment towards that? Are they too bullish, too bearish? Do they have it right? What are they not seeing that I can spot? Okay, let's move on to, if that's kind of the fundamentals and the economy, let's move on to the Fed. What's the Fed going to do? How are they going to react to this data? What are they not seeing that I can see? What's the market's perspective of the Fed? What's their sentiment and so forth? Okay, technical, same thing. And you kind of run it through. And I've asked this before, how many of you sort of daydream a little bit or try to think through those processes of drawing pictures in your head? Okay, this is how it should kind of transpire. The reason that's important, be it during your yoga session or whatever, is you learn to identify and kind of see these pictures coming together, and it's gaining experience that you can harken back to. Hey, I remember how this was in December of 2022 when the markets were so negative and so bearish and so forth, and what transpired and how it played out, and what happened in the currency markets and what happened with commodities, and while the US dollar was doing this, what was happening with gold and so forth. And you try to really get used to those mechanics. And what it will do is it'll really help you to identify when things are going as planned or not as planned. Okay, well, gold should be doing this, theoretically, right? Textbook wise, it should be doing this, but instead it's doing this. And what does that mean? And is this good price action in the midst of bad news or vice versa? And it will lead you towards trading opportunities. So it's all part of that process of building just a strong understanding of markets. My wife has said for years that well, she hasn't said it in a few years, but she would tell me like, "Hey, you were talking about who knows what in your sleep," but it was market related, right? You're talking about the Swiss franc or something, and so the more you think about it, the more you work through it, and so on, the better it's going to get. It's just like any other muscle. It's just a workout session, but I think it's a lot of fun. It's just a fun game of trying to figure out, okay, how do these pieces come together and what comes next. We had a request here. Do you think that Japanese yen and US dollar will start to correlate? So I think they both should start to work in terms of a risk-off environment. So if we're kind of thinking about it from the standpoint of, US dollar, it's been on a slide, and it really, if you look at the correlation, where did it top in October? Where did the S&P bottom in October? The S&P went like this. Where did it stall? Into December. Where did the S&P stall and kind of pull back into December? The markets got super bearish again. US dollar, though, went down and the S&P went up, right? It's inverse correlation. Lately, since last Thursday, the S&P kind of topped out, dollar bottomed out. And I think that's an important turn and pretty good inverse correlation. The Japanese yen, however, has somewhat been moving to the beat of its own drum, but not entirely. Look at it again. It bottomed where the stock market bottomed, right? Where if you're kind of looking at it from the standpoint of correlations, it's been a little bit more positively correlated to the S&P, which is odd, and inversely correlated to the US dollar from that standpoint. Look at mid-December when the stock market bottomed again and made that, like here was the A bottom in the S&P, and then it went down, and in December it made the B, and then it rallied up again. This kind of did the same thing. It rallied, and then it kind of and then it went up again, right? So it's more inverse to the US dollar, but positively correlated to stocks. That's a weird occurrence. But I tend to think that the yen, that's more happenstance than anything else. I don't think that the Japanese yen is always going to positively correlate to the S&P. In fact, usually it's a very inversely correlated asset. I think instead it was more happenstance. It's the old buy the rumor, sell the news. It was already priced in, that sort of thing. This is where I said you got to be careful. Well, probably even before that, but you just have to be careful in here shorting the yen because, again, all of the other central banks had moved except for Japan, and there was a lot of pressure in terms of them keeping their rates where they were, allowing their bond market to freely trade, a lot of things that they had to relent on, which was going to fuel some of these crazy, explosive type of movements. And it just was not an environment, and I still don't think you want to be short the yen. I think, you're gonna see more bursts and just more climbing. Yen's always choppy somewhat for periods, but it will have some bursts and some crazy, upside moves. So I tend to think that the yen is just moving more based off of its own and its correlation to the Bank of Japan and some of the changes that they have to make in policy. So anyway, kind of interesting how those pieces have come together because that is abnormal. It's very abnormal for the Japanese yen to be positively correlated to the S&P, to actually be moving in lockstep. Usually they definitely move inverse and opposite too. All right, so jumping over and looking at the calendar for the rest of the week from our website, we've got the midweek, check, we've done that. We've got a currency recap tomorrow. We've got the trading room this weekend, and then, of course, we get back to it next week. So this week is a little light on economic calendar-wise. There's not. Last week was big on it, right? We had non-farm payrolls, we had the FOMC, we had a variety of things. This week, kind of quiet, but I think an important change has taken place. All right, thanks again, everyone. Have a great rest of your week, and we'll see you next time. Goodbye, everyone.